Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to continue our beginners options course, part 2, talking about how to add leverage to your portfolio, but do so in a way with limited risk. Now, we're finishing up the week with a fairly strong market, actually broke above that 273 resistance level that I was talking about on Tuesday during our market outlook session. So regardless of what your views are in terms of whether you think the market has bottomed and we're going to continue moving higher in this V-shaped recovery, or you see this as an opportunity to potentially short because the economic data and some of the fundamental data simply do not line up with where the equity markets are currently trading. Regardless, we're heading into our earnings season. There's going to be a lot of opportunities for bullish or bearish views in the market. And we want to show you how you can express those views with leverage, but do so in a way with limited risk. So let's go ahead and get started here. Can everyone please pull up your chat window at the bottom of your screen and pull up your chat window at the bottom of your screen. If you have any questions, I just want to make sure everyone can hear me. So please type yes into the chat window if you can hear me. Okay, perfect. So let's go ahead and get started here. All right, so we have a lot to cover, but first step, what I want to cover with you guys here is the fact that, welcome everyone. For those of you that are brand new here to Options Play, what I'll be doing today is I'll be showing you the tools that we'll be utilizing to analyze some of the strategies we'll be showing you. To get access to these free tools, you could access a free 30-day trial using the link that I am showing to you here on the screen. This will give you access to a free 12-step options trading course, as well as daily options trading ideas and a free 12-step options course to help you get started. After the free 30-day trial, membership is just $75 a month or $500 a year. You can sign up using the link on your screen right now if you're a first-time user of Options Play. So before I get started, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, like I said, this is part 2 of our beginner's master course. We finished the first beginner's master course last month, where we discussed the basics of call and put options, buying and selling call and put options. Now we're taking a much more practical approach to understanding the basics of options trading by showing you how to apply this to your actual portfolio. Now, if you joined us last week, we talked about how you can sell calls and puts for your portfolio to enhance the stock and ETF investments that you own in your portfolio. Today, we're going to be talking about how to buy calls and puts, and even an introduction into the more advanced strategies on how to utilize buying options to add leverage to your portfolio, but do so in a way with limited risk so that you can express your bullish or bearish views in your portfolio. Now, it's really important that when you learn about buying a call or a put, you understand the benefits, but more importantly, you understand what the trade-offs are for those benefits. And that's what I want to walk you through here today. So part 2, we're going to be talking about understanding the fundamental difference between stocks and options. We'll break down the basic strategy of buying a call versus buying a put. And then we're going to talk about a more advanced strategy, which really takes buying a call or a put and merges it with selling a call or a put that provides you with some additional advantages, especially talking about limiting risk and adding leverage. How do you maximize the leverage while minimizing your risk? So that's why we want to talk about some of these advanced strategies that allow you to do that. Then what we're going to do is we're going to break down some of the option Greeks. Now, I know the option Greeks many times confuse many investors who are brand new. So I want to try to explain it in a more visual format to hopefully make it a little bit more intuitive. But at the end of the day, you don't necessarily have to know how to calculate the Greeks in order to trade options, but it's good to know it from a conceptual perspective so that when you come across it, you know what they mean. Now, I do have a couple of announcements before we get started. According to the webinar schedule, next week we're going to talk about risk and money management of options trading, which is very, very important. I think one of the most important topics is to discuss. And then we were going to talk about the market outlook and the Q&A on the 30th, However, what I think I want to do is I want to move my earnings special event to next week, because we kick off earnings seasons next week. We have some of the early reports with Bank of America and JPM and next week. So I want to be able to cover, what are some of the early reports, how to trade earnings season next week, and then we're going to push out the risk and money management and market outlook to the following week, so that we have a more timely earnings event for you guys. So I hope you'll be able to join me next Thursday for that. And just a quick reminder also, we normally do market outlooks Tuesdays and Fridays. I know tomorrow's a market holiday, but I still want to do one tomorrow morning, because I want to update everyone on the daily play positions. We have quite a number of short positions that currently have an unrealized loss. So I want to address, my thinking in terms of the markets and those positions and why we're holding on to it. So I hope some of you will be able to join me tomorrow morning, even though the markets will be closed. So let's go ahead and get started. So first off, I'm going to start off by talking a little bit about stock trading, because it's important to understand the difference between stocks and options trading to understand truly the difference between buying calls and puts. So buying a stock or shorting a stock is what I would consider truly a bullish or bearish strategy. And what do I mean by that? When we refer to a bullish strategy, that means a strategy that makes money as soon as the stock goes higher. A bearish strategy is a strategy that makes money as soon as the stock moves lower. And that's exactly what stock trading provides you with. When you buy the stock, or you have bullish exposure. When you short a stock, you have exposure. And both of these strategies provide immediate gains if the direction that you call is correct. And that I think is the best definition of a bullish strategy and a bearish strategy. And this provides with what we call symmetrical exposure. So if a stock goes up by $1, you make $1 when you buy it. If it goes down by $1, you lose $1. It's very easy to also calculate your potential P&L with something with symmetrical exposure. And you can trade this on any time horizon. You can buy a stock and hold on to it for a second, a minute, a year, however long you want, as long as you have the margin to continue holding on to that trade. The only limitation that you have with stock trading is the fact that you have no neutral options. So if you think the stock is going to stay where it is and it's not going to move very much, chances are you may not trade that stock. And I would argue for many investors, short selling a stock is also a strategy that doesn't really fit into your portfolio. Maybe because you don't have a margin account, maybe because you don't want to take on the risk of having unlimited risk, so that if you are wrong and the stock goes higher, that you truly have unlimited risk. So for many investors, what we tend to find is that they are only seeking bullish opportunities, which means that you may be limiting in terms of what type of opportunities you seek in the market, especially in this type of market environment where, as markets rebound almost 20% from the lows, you might say to yourself, I don't think this is the right time to be buying more equities, especially going into a recession, going into some of the terrible unemployment numbers that we're about to see coming out. You might think that it's not a smart idea to buy stocks. Maybe you think stocks are going to pull back. So as an equity investor, perhaps the only thing that you're going to do is move your assets into cash and sit on the sidelines. As an options investor, you can trade different opportunities. So let's talk about some of those. So first, what I'm going to talk about are call options. This is something we've discussed in our first beginner's options course. This is what we call a bullish strategy. Now, if you remember from our first course, I actually clarified that when we say that we're buying a call option, it's not fair to call it just a bullish strategy. It's bullish by a certain amount. And if you remember from that course, we talked about bullish by a certain amount. That amount depends on the price of that call option. So here I have a chart of a stock that's trading at $100. This happens to be Waste Management, but I've just pulled that because it just happens to be trading around 100. Now, let's say I'm bullish on this stock. I think this stock is going to rise. I think it's going to move higher in the future. Maybe I think it'll go to 110, where that 50-day moving average is on this particular chart. So if you think that this stock is going to move higher, what can you do? So as an options investor, you know that you can buy a call option. That is a bullish strategy. But again, I want to clarify, a call option is bullish by a certain amount, and that amount depends on how much that call option costs. So in this particular example, let's say I buy a 100 strike call option, an at the money call option. Let's say it cost me $4 to buy that call option. So what that means is that my break even on this particular trade is $104, meaning the stock needs to move by the amount that I paid for that call option in order just to be profitable. So what that means is that not only do I have to be bullish on this particular stock, it requires a 4% upside just for me to break even. So I have to really go back to the drawing board, look at the stock itself, and say that, in this amount of time, in this particular case, I didn't specify an expiration date, but whatever the expiration date is, I have to ask myself, by that date, do I think the stock is going to be above 104 or higher? If I think the stock's going to go to 110, then yes, it would make sense for me to buy that call option. But maybe, let's say I think it's going to go to 105. If it's only going to go to 105, there's really not a lot of profit here. I'll still be profitable, but it doesn't make a lot of sense because, first of all, I'm risking $4 a share or 4% of the underlying stock price. And if the stock rises to 105, I would only make a $1 profit. So I'm potentially making $1 in exchange for risking $4. That's not a particularly great risk to reward ratio that most people want to take because there's always the possibility the stock doesn't move higher. There's always the possibility the stock moves lower. There is one benefit to trading this call option, and that's if the stock was to plummet, let's say for whatever reason, I just completely get this wrong, and the stock plummets down to that $85 level. If I was a stock investor, I would be losing $15 a share. I'd pay $100 a share for the stock. If it declines to 85, I'm losing $15 a share. In the call option here, I'm only limited to $4. No matter what happens, even if the stock goes to zero, I'm only risking $4 a share. So that's the trade-off that you're making here with this call option. The fact that it needs to move 4% to the upside just to break even, but to the downside, you're limiting your losses to just $4 a share. And that can be really, really helpful, especially when you're trading in very volatile markets, especially when you're trading in markets where you think the markets may be moving a substantial amount, then you're able to utilize an option to effectively have a stop loss on your trade, but still take advantage that if the stock was to move significantly higher, that you're still able to participate. Your max reward in this particular strategy is unlimited. So one of the great things about trading a call option is that if the stock continues to move higher, there's no limit as to how much money you can make. So if in a short amount of time, maybe some really positive news comes out, maybe there's a cure for coronavirus and everything starts to rally, you're able to participate unlimited to the upside while risking only $4 a share. The downside to all of this is that if the stock stays flat, if it stays at 100, or if it goes to 99, or just stays where it is and it doesn't move, you're still going to lose $4 a share. So your loss here is $400 a contract, but you have unlimited upside. So that, I think, for most users, is a pretty simple breakdown of what a call option is. And I'm sure most of you are familiar, but I just want to check in. Does everyone make sense? Does this make sense to everyone? Please type 1 into the chat window if this simple setup of using a call option to take a bullish view makes sense to everyone. Okay, great. So far we discussed some of the benefits, some of the drawbacks of utilizing call options. Now what I want to do is I want to show you how you can use the power of options to tweak this a little and improve it and turn the risk and reward ratio in your favor. So that's where we're going to turn to debit spreads. Now, debit spreads really just combine buying and selling call options into a single strategy that allows you to get the benefit of both worlds. So same example, I have stock XYZ trading at $100. I think this stock is going to rally. So what can I do? In the first example, what we said is we can buy a $100 call option. We said that call option costs $4. So that requires us to risk 4% of the underlying stock price, and the stock needs to move 4% higher in order for it to make sense for me to buy this call option. So let's say I think the stock is going to move 4% or higher by expiration, but how can I maximize return? How can I minimize my risk? And that's where we can turn to selling an option. So what you can do is you can buy that $100 call, but think about when you're trading an option. An option has an expiration date. Let's say I trade a May option or June option in this particular case. You have to ask yourself, yes, I'm bullish on the stock, but there's only so far this stock can go by May or June. So you can ask yourself, you can use, and there's plenty of different ways that you can figure this out. You can use technical analysis, you can use prior resistance levels, you can use statistical analysis to get a sense for, yes, I think this is going to go higher in the next couple of months, but how far could it possibly go? And what you can do is you can sell a call option at your target price. So let's say I have a target price of 110 here. So what I can do is I can sell a 110 call against it and collect a premium for selling that call option. So for those of you that remember selling a call option from our first course, you'll remember selling a call option obligates you to sell the stock. Buying a call option obligates you to buy the stock. So the two net each other out in terms of obligations. So what you have here now is that instead of paying $4 for this bullish upside trade, now you still have the same bullish upside trade, but you're now spending a smaller amount of capital. Now you're only spending $3 for this trade. So yes, this is still a bullish by a certain amount trade, but now you only have to be bullish by a smaller amount because now you're risking $3 instead of $4 and you're paying $3 debit for the whole trade. Now your break-even price instead of being 104 is now only 103. So now you only require 3% upside. So now you have a higher probability of making money on your trade. You have a higher probability of having the stock being above your 103 level. You're risking less money now. You're risking only $3 a share, which means that you also have to put up less capital to get into the trade. And what you can do with that is you can say, well, now I can trade more contracts because it costs less per contract. So there's various ways that you can utilize this strategy to your advantage. So you can either increase your leverage or you can decrease your risk here on this particular trade. Now, the trade-off here is the fact that by trading this type of strategy, by selling that 110 call, instead of having unlimited gains now your max gain is just $7 a share. But what I want to do is I want to walk you through a few different examples, right? So in the previous example, we said that you needed a stock to move up to 104 to break even. So if you thought it was going to go to 105, it didn't make a lot of sense to trade that because you're risking $4 a share to just make a single dollar. Now, if you trade this vertical, notice how if you think the stock's going to go to 105, it might make some sense to you now because if the stock moves up to 105, you would make $2 on this particular trade while risking only $3 on that particular trade. Not the best risk reward ratio, but certainly a hell of a lot better than risking $4 to make $1 when you're risking $3 to make $2. That's a 66% return versus just a 25% return on your capital. So this is really how you go about utilizing options to your advantage by combining buying versus selling options. Now, the only time here that you're really at a disadvantage, if you will, is if the stock goes from 100 to maybe, let's say, 120. Because in this particular case, if the stock goes from 100 to 120, the most you'll make is $7 a share, versus in the previous example, if you bought a call option, you would make $16 a share. But keep that in mind that, chances of that happening are fairly slim. So if I didn't take that to such an extreme example, if let's say the stock went from 100, let's say it exceeded our target. Let's say it went from 100 to 115. So here what I'm doing is I'm risking $3 to make $7. In the previous example, if it went from 100 to 115, what I'd be risking is $4 to make, in this particular case, it went to 114, 11. So here I'm making a little over 200%. Here I'm making also a little over 200%. So even if it overshoots, I'm still going to have roughly the same return simply because my denominator is smaller by 25%. So when you reduce your risk by 25%, it greatly outperforms your specific strategy, even if it overshoots your target by a bit. Because I usually get a lot of comments saying, well, the debit spread really limits your profit potential, but you really have to overshoot your target by quite a bit before you start underperforming, because you're outperforming very, very quickly in the early stages, and it really takes a big move to the upside for you to start to underperform. So I want to make sure everyone understands this. Please type 2 into the chat window if these debit spreads make sense to you as to why you want to learn these strategies if you're brand new to these strategies, and if you are if you already have some experience trading these complex strategies, why you should continue utilizing them, especially in this type of market volatility. Okay, perfect. I see a lot of 2s. Great. So the next 2 examples are basically the exact same thing, but turned on a dime for bearish opportunities. So for those of you that are brand new to bearish opportunities, for those of you that are stock investors, maybe you've never shorted a stock before, so you've never even thought to look for stocks that you think are going to underperform, or stocks that you think are going to move lower. Now we're expanding your universe by doubling the potential opportunities that you might seek in the market. So same stock XYZ, let's say you think that the stock has declined down to 85, it's rallied enough and you think it's going to continue moving back lower. Regardless of how you come to your conclusion, what you can do is you can buy a put option. This is a bearish strategy, but again, this is a strategy that if you took our last course, you'll remember a long put is not just a bearish strategy, it's bearish by a certain amount because you have to pay for that put option. So in this particular case, if you buy a put option for $4, then that requires the stock to move $4 lower in order for this strategy to be profitable. So this strategy requires a 4% downside. So not only do you have to be bearish on the stock, you have to ask yourself, do I think this stock is going to go below $96 or lower? If you don't think it's going to go below $96 or lower, do not buy the put option, even though you're bearish, because you can say that I think the stock's going to go down to 96, buy the put option and make no money on the particular trade. That's not a smart investment to do. So you have to make sure that you remember that when you buy a put option, you have to look at how much does that put option cost. So in this particular case, if it costs $4, then I'm risking $4 a share, or 4% of the underlying stock price. I quote the 4% because I think it's important that sometimes you think about how much is a put option as a percentage of the stock price. When you're in the 3 to 5% range, those are relatively cheap call or put options. When you're spending 10%, those are really expensive call or put options, because now you need the stock to move 10% just for you to break even on the specific trade. In the 3 to 5% range, that's much more reasonable. But even a 3 to 5% move, that doesn't happen all the time. So it's really important that you know how much you're paying. Now, in this particular case, your max reward also is unlimited, because if the stock goes all the way down to 0, you can actually make up to $96 per share. Your max loss is simply if the stock stays exactly where it is or moves higher. So this is, again, a mirror image of what we just discussed with the call options. But before I move on, please type 3 into the chat window if the put option makes sense to you, or the numbers on this screen make sense to you. Okay, perfect. So lastly, let's talk about how to turn a bearish put spread, a put, into a spread that can give you some additional benefits here. So same example, stock XYZ, $100 stock. I think the stock's going to move lower. What can I do? I'll buy that put option for $4. But again, that requires the stock to make a 4% move to the downside in order for me to make a profit. But chances are, even though I'm bearish on a stock, I may not think it's going to go to 0. So why should I pay for all that downside? Because when you buy a put option, you're paying for that downside. Why pay $4 for it when you can effectively sell off some of that downside for some credit? And that's exactly what we're doing here when we're selling a $90 put option and collecting a $1 credit. So by collecting a $1 credit, what we're doing is we're reducing our risk and our debit from $4 a share down to $3 a share. So now, instead of requiring a 4% downside, now it only requires a 3% downside. Now, obviously, a stock will have a better probability of moving only 3% than 4%. So you're increasing your probability of profit. You're decreasing your risk on the overall trade from 4% of the underlying stock price now to just 3% of the underlying stock price, which is actually a 25% reduction in risk. And a 25% reduction in risk, like we showed you before, is significant, because if the stock declines from $100 to, let's say, $95. In the previous example, what you've done is you've risked $4 to try to make a single dollar. That's only a 25% return on your capital. If instead you use a debit spread here, what you're doing now is you're risking $3 to potentially make $2, which, guess what, is a 66% return on your capital. Now, which one would you rather have, 25% or 66%? I know I'll take the 66%, and I know that I'd rather risk $3 to place this trade rather than risking $4 to place that trade. And that's why we predominantly use debit spreads when we are taking a bullish or bearish view using our daily plays. Now, again, this is useful for when you expect a stock to make a specified move. So not suitable for every single type of trading, only suitable for stocks that are going to make a decent sized move. There are various ways that people scan for those types of opportunities, whether you use technical analysis, whether you use fundamental analysis. But regardless of how you go about finding your strategies, this is strategy that's only suitable for when you expect a relatively big move, because I still need a 3% move to the downside just to break even. So what I really need is a 5, 6, 7% move in order for this to be really worth my while. And not every day do you find stocks that you think are going to move 6, 7, 8% in the next month. But those are the opportunities that you want to see when you're using this type of strategy. So before I move on, please type 4 into the chat window if this makes sense to you. Okay, perfect. I see a lot of 4s. So now what I want to do is I want to cover a topic that I think for many people is difficult to grasp, and those are the option Greeks. And I want to try to make this a little simple. I want to make it a little visual to hopefully help everyone understand the Greeks a little better. Now, the option Greeks, from my perspective, are very important to understand from a conceptual perspective. They're not important to understand from a calculations perspective, simply because every single options trading platform you use under the sun calculates these things for you now. So you don't have to know how to do the calculations. And the only reason that you ever learn that you learn about the Greeks is because you want to know, if the stock goes up by a certain amount, how much do I make? If the stock goes down by a certain amount, how much do I lose? And options play and most platforms now will do the calculations for you. So even if you never understand this and you never understand the calculations, you can still trade options. But I find that if you understand the Greeks, it makes your selection of options a lot easier. It makes understanding of how a trade is going to work out a lot easier. So it's important, in my opinion, to at least understand it from a conceptual perspective. So first Greek we're going to talk about is delta. Now, just by a quick raise of hands, yes or no, how many of you are familiar with the term delta? How many of you are not familiar with the term delta? Please type yes into the chat window or no into the chat window, depending on whether you feel that you have an understanding of delta or not. So I see a predominant answer of yeses, quite a few no's as well. So let's just quickly go over this. So I think, first of all, delta is by far the most important Greek for anyone to learn, because delta is really the Greek that has the largest impact on your P&L. So whenever you buy or sell a call or a put, delta is what's going to influence the value or the change in the value of that put option or call option the most. So delta simply tells you the change in the underlying price of the option with respect to the change in the stock price. So what I have here at the bottom is the stock price. So the stock, let's say it's trading at $100, can go to 110 or maybe decline to 90. So what you're trying to know when you're using a Greek like delta is, if the stock goes up by a certain amount, how much does my option value go up by? So if you see a delta of 0.5, what that's telling you is that if the stock was to move up by a single dollar, your option would increase by 50 cents. So what that means is that if the option goes from 100 to 101, your value of your call option would move from, let's say, in this particular case, let's say you buy a call option for $4. Then if the stock goes up by $1, your option would move up by 50 cents. So it would increase from $4 to $4.50, which is a 50-cent increase on $4 stock is about 11%, 12% gain on your underlying stock. So a 1% move in the underlying stock resulted in about a 12% gain in your option value. So that's why delta is so important, because you want to know if the stock goes up, how much money do I make? If the stock goes down, how much money do I lose? Now, something that you're going to notice is that the reason that we have what we call asymmetrical risk is the fact that, you know, a call option will give you higher and higher gains if the stock keeps going higher and higher. But if at some point as the market moves lower, what happens is you have smaller and smaller losses, meaning if the market keeps moving lower and lower, you don't actually lose much more money on a call option. And how many of you have seen a curve that looks similar to this on the red line on your platform or on an options analytics, you know, this type of red line? Please type yes into the chat window. So what the red line represents is how your call option will respond to the stock price movement today. What the green line will tell you is how the call option will respond at expiration. So what the red line represents is if the stock was to make a 1% move today, how much money would your call option increase by or decrease by? And what you're going to notice is that as the market keeps going higher and higher, what happens is the call option starts to act like a stock, just like the stock position that we showed you earlier. And as it gets lower and lower, what happens is it acts like it has no effect at all. At the extreme ends of the curve, what you have here is a stock move to the upside, and on the other side, you have effectively no losses. And that's what we call asymmetrical risk. So what's missing here between how come you get higher and higher gains when the stock goes higher, and how come you get lower and lower losses when the stock goes lower? And that comes down to gamma. So gamma tells us the change in delta with respect to the change in stock price, meaning the delta, meaning for every dollar the stock moves, it's not constant, meaning for every dollar the stock moves from 110 to 111 is different from 90 to 89. And because gamma will actually change delta as the stock goes in your favor or if the stock goes against you. So if the stock goes in your favor, it'll keep increasing delta until delta approaches 1. If the stock keeps going lower and lower, gamma will keep decreasing until delta approaches 0. That's how we get this asymmetrical risk, so that if the stock goes higher and higher, delta gets closer and closer to 1, which acts like the stock. And as the stock goes against you, gamma will keep reducing delta so that delta gets closer and closer to 0, so that for every dollar the stock continues to move lower, you risk less and less money, or you lose less and less money. So gamma is what changes the delta, and it was what causes this asymmetrical risk, the convexity that we're currently seeing on this red line, that shows us how the option will gain more and more money or give you unlimited gains when you call the direction correct, but how is it able to then on the same flip side give you limited risk to the downside? It all comes down to gamma, because gamma is constantly changing delta as something goes in the money versus out of the money. So I know that this is a little confusing, but hopefully this makes it a little easier to understand. And I think another way to look at this is if you look at a $100 call option. Let's say the current, you buy a $100 call option. Let's say the current stock is trading at, let's say the stock is currently trading at 110, and you have a $100 call option. That's an option that's in the money, right? If the stock's trading at 111, I'm sorry, 110, and you have a $100 call option, that's a call option that's $10 in the money. So a call option that's $10 in the money has a very high delta, which means that when the stock goes from 110 to 111, you're going to make roughly almost $1 move. Not quite $1, but very close to $1, because gamma will increase for every dollar the stock goes further and further in your money. Now, let's say you flip this on a dime. Let's say the stock is currently trading at $90 and you own a $100 call option. So now your call option is really far out of the money. Now, we know many times calls that are out of the money have very low deltas. So what that means is that if the stock goes up by $1 or goes down by $1, the value of your option doesn't move by very much, because as you can see here, if you look at that curve is relatively flat down here in the money. That curve is much steeper when it's in the money. So that's how we can use gamma to give us a sense for just how delta is going to change over the period of time, or as the stock moves higher or lower. And that's really what provides you with this asymmetrical risk. So gamma is really what we're long when we're buying an option, and gamma is what we're short when we're short an option. And lastly, theta. The best way to understand theta is looking at this red curve that I showed you here earlier before. And what you're going to see is that as you approach expiration, this curve will closer and closer mimic this green line. So let's say prior to expiration, or let's say when you buy the option might look something like this. When you get closer to expiration, that option is going to look something closer to this, where it's going to hug that green line much closer. Sorry about the bad drawing here. But basically what happens is, as you get closer to expiration, your curve is going to consistently move to the downside. And that's the theta decay, or the time decay that we refer to, the value of your option decreasing in value as you approach expiration, because as you approach expiration, the value turns into that green line. So your curve turns into that green line. And theta tells us, measures how much that red line decays day by day. So if you have a theta of 0.05, that's telling you that that curve will decrease by 5 cents and get closer to that green curve by 5 cents, decreasing the value of your call option. So that's how you can use theta to give you a sense for how much your value of your option will decay. So, for those of you that have studied calculus, I don't know if any of you are engineers and you have a decent understanding of calculus, but really what we're talking about here are really just slopes of curves. The red line is a curve, and delta is the slope of that curve. Gamma is the convexity of that curve, or the second order derivative of that red curve. And theta is not a derivative the same way. But for those of you that are familiar with calculus, if you want to read out more about this, that, in my opinion, that's the best way for this stuff to click in your head, is to do a refresher on derivatives, on slopes, and calculating slopes, because that's really what we're doing here when we talk about delta and gamma. So with that, let's jump over to options play. Let's look at some examples of some bullish and bearish strategies. Let's look at the difference between buying a call option and the debit spread. Before I do, again, I just want to remind everyone, we are doing a Tuesday and Friday morning session. You can sign up using this link on your screen, which I'll post into the chat window for you to join us tomorrow morning. So let's take a look at the markets. Markets have managed to break out above the 273 level. I'll talk about this a little bit more tomorrow morning. This was the level that we talked about earlier this week. Markets broke out above 273, trading now at 278, ending the week up relatively high on optimism that we are past the peak in terms of coronavirus cases. We still expect there to be some stuff trickling in over the next couple of weeks, but we think that we have a pretty good grasp as to when we'll peak and how this will conclude here in the US. And we're talking about how to reopen our economy. There's a lot of optimism around that. We're talking about more stimulus. The Fed has continued to provide liquidity in the markets. So I think there's a few different ways that you can look at the markets. You can say optimism is back. We're gonna get back on our feet sooner than later, which is certainly a good thing. Or you can look at the other way and say nothing has fundamentally shifted from last week to this week, even though the markets are roughly 10% higher. Economic outlook is still fairly bleak. Consumer spending is down 30–40% in the more conservative estimates. We expect a fairly longer recession than we did even a few weeks ago. Maybe things are going to start, as we get into the earnings season, that there's going to be some bearish moves. So we're going to take a look at both cases just so that we can show you from an example, because right here, this is more so that you can better understand the strategies themselves rather than looking at specific ideas. So let's take a look at, let's just use the market. Let's use SPY, for example. Let's take a look at buying a call versus a call spread. If you think that the fact that we managed to break above 273 is a bullish signal and you think the market's going to continue moving higher, let's take a look at buying a call option versus a call spread. So in this particular case, let's just walk through it just so I can show you here. Buying a May 22nd 278 call, which is the at the money call, costs $1,392, $13.92 per contract. This gives me a break-even price of $291.92. So $1,300 to buy a call option. Buying a call spread, which options play will automatically do for you. So for those of you that are thinking as you went through those spreads and you're thinking, well, how do I go about selecting your upper strike? We actually do this work for you. We take a probability-based approach. We're selecting a strike price that's one standard deviation away. So there's only a 15% chance that the market will be above that strike price at expiration. So relatively low probability of that happening. And again, even if you overshoot that level by a little bit, you will still likely outperform just the outright call option because you're reducing your risk or reducing your overall capital investment. So here, $1,392 to buy that 278 call. As you can see here, if I buy the 278 call, it'll still cost $1,392, but I'm collecting $1.40 to sell the 310 call against it. Not a lot of premium here in this particular case, but I am collecting a little under 10% of the cost of that long call. So here it only cost me $12.52. Now, not a huge difference. My break-even price improves from $291.92 to $290.52. So about $1.50 lower on my break-even price. So what I can do is I can use my P&L simulator and I can say, well, what happens if this stock rallies up to, let's say 300? Let's say the market rallies back up to 300, which I think is a pretty bullish case in this particular environment. But if let's say it did by May 22nd, as you can see here, if I bought this call option, I'm looking at a 58% return, which is not a bad return in a month and a half for the markets to move another 20 bucks to the upside. But as you can see on the call spread, I'm looking at a 75% return. So even though I'm reducing my cost by a fairly small amount here, right? I'm only reducing it by less than 10%, only about 7% here. I'm boosting my returns from 58 to 75. So a fairly significant gains in terms of my return, and I'm risking $150 less on the trade here on the right. So this is just a first step, a first glimpse into how you can utilize a debit spread to create a better outcome for your trades. Let's take a look at, I don't know if anyone has some symbols that you might want to take a look at, but let's say you want to take a look at a stock like, I don't know, let's say McDonald's. Let's take a look at McDonald's. Now, I don't know what everyone's views are here on McDonald's. I think it's a pretty interesting that McDonald's has managed to rally more than 50% off of that initial low, given the fact that restaurant spending is down roughly 60%. Unemployment is relatively high. They unfortunately have a lot of exposure to lower income, which is the group that's most affected by coronavirus and these unemployments. So maybe you might want to take a look at a bearish view on McDonald's. And again, these are not meant for, these are not recommendations. This is purely just so that we can show you some examples here. So buying a put option here, so McDonald's at 183. Let's say we buy a 185 put, which are the at the monies, costing me $13.50. Here, I'm buying the same 185 put, spending at $13.50, and selling the 155 puts against it, collecting $1. Again, in this particular example, not a lot of premium on these out of the money put options. And this speaks to some of the abnormal markets that we're currently trading in. So I'm reducing my risk from $13.50 to $12.50, which means that I've increased my break even by $1. So my break even, instead of being $171.50, is $172.50. Not a big difference, but let's just take a look. Let's say the stock declines back down to maybe 155 or so. If it declines to 155, if I bought the put option, 122% return, the put spread, 140% return. So not a huge difference, but as you can see here, I am reducing my risk by $100 and I'm increasing my potential reward by roughly 20%. Not a huge move here, but still not bad in my opinion. Let's see if we can find some better ones. Someone suggested Boeing. Let's take a look at Boeing. Boeing is really kind of in a bit. It had that really nice rally up to that 180 level. It's really sitting sideways here. I don't know if anyone has any bullish or bearish views on this particular stock, but let's just, for argument's sake, let's take a bullish view for Boeing. Buying a call option, a 150 call option, cost $2,255. That's an expensive call option. So let's say instead of just buying the 150 calls, I sell a 200 call against it. Here I'm collecting $3.55. So here I'm actually collecting a little bit more than 10% of the long call option. So that is usually the realm that you're really looking for, 10 to 20% of the long call or the long put. So here I'm collecting $3.55, which is a little bit more than 10%. So I've reduced my break-even price here from $172.55 to just $169. So I've increased my probability of profit here by about 2 percentage points, and I've reduced my risk from $2,250 to $1,900. So let's take a look at what reducing my risk by 15% really equates to. So let's say that let's first start with saying, let's say Boeing makes it back up to that 180 high that it put in just a couple of weeks ago. Notice how if the stock moves up to 180, if I bought the call option, I'm looking at a 33% return. Now, these call options are really expensive. So even if you get a nice move to the upside, you're only looking at a 33% return. In my opinion, that's not a trade that I would ever take. If I bought the call spread here, I'm looking at a 57% return on my return on my capital. Also not particularly attractive, but certainly a hell of a lot better than only getting 33% return on my capital. I usually don't like to risk $1,900 to just make $1,100 on a particular trade. I would only take this trade if I thought that Boeing was going to rally above that 180 strike, which is possible. So if you do think Boeing is going to rally up to, let's say, 200 on some more optimism here, as you can see here, again, 121% return on the call, which certainly is a great return, but 163% return on your call spread because again, you're risking instead of 2,200, you're only risking 1,900, which boosts your returns by a substantial amount. Someone else wanted to take a look at GLD or Bank of America. Let's take a look at Bank of America real quick. Bank of America, rallied 6% today, which is a pretty big move. The banks actually have been doing fairly. The banks are interesting because they're trading below their book value right now. And, just from a valuation perspective, look fairly attractive. So let's say you want to take a bullish view, and Bank of America reports earnings next week. So we're going to talk about earnings plays. This is not meant as an earnings play, but let's just take a look. Buying a 24.5 call option will cost you $235. Buying that same 24.5 call option, but selling the $30 call option against it collects 20 cents, which is roughly 10% of the long call. So that's almost a 10% reduction in savings or risk. So as you can see here, if the stock does rally back up to, let's say 27, I don't think it'll go all the way up to 29 since it's already rallied quite a bit off those lows. So if it rallies up to 27, notice how these call options make almost no sense. So even if you get another 6%, 8% move to the upside, you're actually just breaking even on the call option. Again, that's why when you buy a call option, you can't just say to yourself, oh, I'm bullish, so let me go out and buy a call option. You have to look at how much does that call option cost? Because in this particular case, guess what? $235 is almost 10% of the underlying stock price. So the stock needs to rally almost 10% just for you to break even, as we're showing you here. So in this particular case, if you traded the call spread, still, in my opinion, not great, because if the stock rallies 10%, you're looking at a 16% return. Certainly a lot better than the 6% return, but not attractive at all. But this is really how you can utilize options play to do the calculations of delta for you, because that's what the price slider is actually doing. It's calculating based on delta how much money you should expect to make. The time slider shows you how much money you would expect to make due to time decay, and show you the effects of time decay as the value of the call option erodes and approaches expiration. And lastly, Vega, which is the changes in implied volatility. We're going to discuss that next week on our special earnings play webinar, where we're going to discuss how volatility impacts the value of your option. Now, this typically really applies traditionally on when you're trading a earnings play, because that's where that's when you're likely to see the largest shift in the underlying implied volatility. So let's just take a look at one more example before I open this up for Q&A. GLD. This is an interesting, I think ETF to continue to look at, especially given the fact that, when we're looking at $2 trillion in stimulus, when we're talking about unlimited QE and interest rates at 0 and potentially even more curve suppression from the Fed, this might lead to inflation, and gold is usually used as a hedge for inflation. So maybe you think gold is going to continue moving higher. And look, interesting enough, very interesting trade. Buying a May 158.5 call option costs $550. Buying a call vertical here, where I'm buying the 158.5 call, spending $5.50 for it, but I sell the 172.5 calls against it, collecting $1.59. I've reduced my risk by almost a third in this particular case. 555, 159. So let's see how that performs. Let's just say gold makes it back up to that 160, let's say 162, 163, just a little bit higher than the 52-week high. So if the stock goes up to if the ETF goes to 162, guess what? I actually lose money on the put option because I'm paying $550 for a 158. So my break-even price is 164. So the stock has to move a fair amount just for me to break even. If I bought the put spread, I'm basically at break even here because I've reduced my break even from 164 to 162.40. So basically I have to believe that this stock will go above 164, let's say to 165, in order for this to be profitable. But notice how big of a difference in terms of return here is. 18% return on the call option, 66% return on the call spread. Because I've been able to reduce the risk on my trade by a substantial margin, it increases my return by also a substantial margin. And this is really why, in my opinion, it's one of the best strategies to utilize when you have a directional view, especially when you can reduce the cost of your trade from, in this particular case, by almost 33%. Because that 33% savings in the amount of capital it requires you to trade that is going to amplify your returns by a substantial amount. As you can see here, 18% to 66% just by reducing the cost of this trade by that $1.50 by selling that 172.5 call option. And the question, I have a question here, is what happens if it goes to 172 or higher? If it goes up to 172, and notice how you get a substantial higher return here. And again, this is what I mean by you start to outperform very early on the call spread, so that even if it goes above 172, the stock really needs to move all the way up to roughly, in this particular case, 177. So it overshoots that higher strike by $5 before these two are actually the same. So you would have to go above 177 before the call option expires. So this is really where, even though debit spread, a lot of people say, hey, I don't want to limit my risk. The reality is you have to overshoot that upper strike by a fair amount before you start to underperform. And chances of that happening, again, are very, very slim, because there's only about a 15% chance that the stock exceeds that upper strike. For it to exceed that upper strike by a fair amount, in this particular case, another $5, is even lower. You're probably looking at only about a 5 to 10% chance of that happening. So in the 95% of the times when you do, when the vertical outperforms, you're going to have a lower amount of risk and you're going to have a higher return on your trade. So with that, that covers what I wanted to show you guys here today. Remember that when you're trading options, it's really important that you understand what your potential benefits are, but also what you're trading off with that. And when you're buying an option strategy, the trade-off really is the fact that the stock needs to move in order for you to break even. So you have to ask yourself, how much does the stock need to move? That depends on the price of the option, whether you're buying a call option or a call spread. You still have to look at the price of that option. That determines how far does the stock need to move. And then you can go back to the drawing board and say, well, do I think this stock, is the stock going to move that amount or more? If you do, go ahead and buy that call or put. If you don't, you should not buy that call or put option, even though you're bullish or bearish on that underlying stock. So I hope that this was useful in helping you guys better understand that principle, because it's so important to be able to be successful in options trading. So I hope to see those of you that are interested in joining me tomorrow morning at 9 a.m. On our regular Tuesday and Friday morning session, even though the markets are not open tomorrow. I do want to update everyone on where we currently see the market, our daily play positions, and why we're holding on to them, for those of you that want to join us. And just before we turn over to Q&A, I just want to remind everyone, I hope that you, for those of you that are on a trial or currently have an expired trial, consider supporting us by becoming a member just at $75 a month or $500 a year, giving you a full year's access to everything that we showed you here today, the platform, the daily trade ideas, these weekly webinars, the monthly, the weekly market outlook seminars to help you stay on top of the markets. So thank you so much for your support. For those of you that are members, really looking forward to having more of you join our community. So let's go ahead and turn to some of the questions here. I know there are a lot of questions. I'll try to get to as many as possible. I'm glad to hear some of you are, watching some videos on derivatives. There are some great YouTube videos out there. I really, really think that they are critical for many of you that want to learn more about options, just to learn a little bit more about calculus. How can you sell a 100 option at 110 and gain a credit of 100? That's if you, not sure I understand the question. If the stock is trading at 100, the 110 options are going to collect less of a credit than the $100 call options. So you're going to be able to collect, some premium for selling those out of the money calls or puts. That's how you gain that credit. For those of you that are interested in watching some of our previous videos, you can follow us on our YouTube channel, which I'll post a link to the playlist in the chat window. I highly recommend, if you want to look at any of our previously recorded webinars or sessions, please go to our YouTube channel. I just posted that link. Follow us on YouTube, turn on notifications, because that's going to allow you to get a notification every time we post a recording. Even if you didn't join us, you'll be able to get that notification. Let's see. How do you select the correct sell, put, or call for the debit spread? So I talked about that, where we use the one standard deviation move. So something that only has about a 15% chance of the stock exceeding that level by the expiration date. Yes, this will be recorded. How long before expiration does theta turn into the green line? So it's a constant burn. So every single day you go by, it moves little by little towards that green line, Michael. What platform are you using? This is the options play tool, Stephen. So Stephen Hardman, you can sign up using the link that's here on your screen. Whoops, maybe I closed it. All right, let me get back that link for you guys. If you want to sign up for a free trial to the tools I just showed you here today, you can sign up using this link here at the bottom of your screen, which I am posting into the chat window. Let's see, a lot of questions here. Let me try to get to as many questions as I have time for here. Is options action on tomorrow? I don't believe options action is going to be on tomorrow because it is Good Friday. What do the two-digit numbers in the red, green? Oh, so the question is, what does the options play score mean? The options play score is simply just a risk to reward ratio, because many strategies, you have unlimited risk or unlimited reward, and you'll say to yourself, how do I calculate risk to reward on something with unlimited reward? And we wanted to create a solution for that. That's why we created the options play score, to give you a sense for the potential reward versus the potential risk. and allowing you to compare the risk to reward against each strategy. So in the example here, if the stock goes higher, I make a higher return. If the stock goes lower, I risk less capital, and that's why the strategy here on the right gives you the higher options play score. Are all the stocks on the left also on the liquidity list? Yes, correct. They are all on the liquidity list. What time is your review on Friday morning? It's 9 a.m. Eastern. Would 58% for call spread versus 33% for call be worthwhile given the potential risk of assignment with the spread? So Chris asked a great question, and Chris seems to be concerned about the risk of assignment. Your risk of assignment on a debit spread is virtually zero. You really have very low risk of assignment because, first of all, it doesn't make sense to exercise a call that's in the money before expiration. And these types of strategies you usually don't hold to expiration. So let's say I buy this call option and the stock goes to, let's say, 180, right? So we're above that strike price, the call strike. First of all, it rarely makes sense to exercise a call option early. It sometimes makes sense to exercise a put option early, but rarely for calls. But still, you would exit this trade prior to expiration. And even if you get assigned on it, your risk doesn't change because all you're now is you're short 100 shares of the stock that's offset by the long call option. So your risk doesn't change if you get assigned. So don't be afraid of assignment on this particular trade. And Chris, I would say certainly I would rather take a 58% gain versus 33% because the assignment doesn't change my risk profile. So if it doesn't change my risk, I'd much rather have 58% gain than 33%. How is implied volatility calculated? Great question. Don't have time to get into that. It's not that difficult to calculate implied volatility. You're really just backing out what the expected volatility, and you're using the price of the call option and assuming that using a normal distribution, what is the probability of the stock being 68% of the probability of the stock being a certain price 1 year from now. I will do a video on volatility and advanced volatility in the next intermediate course. So I will cover that, but I don't have enough time to get into the calculations of implied volatility on today's Q&A. What is the impact of volatility on the long option and spread? Is the volatility a concern for the spread? Great question. The answer is the volatility has a relatively small impact. So as you can see here, now granted this is near expiration. Let's go closer to expiration. And maybe we'll go somewhere near. As you can see, volatility has an effect on the value of your option, but it takes a very, very large move of volatility to have that. A small move in volatility, so volatility goes from 24% to 22%. As you can see, your changes in your trades are fairly small versus the changes in delta have much, much larger impacts. So the most sensitive Greek is delta. Theta has some effect, but relatively small compared to delta, and Vega also relatively small compared to delta. Delta is by far the most sensitive and the largest impact, the one that you want to pay attention to the most. Maura is asking, would you really take a call or put option spread with a score of 60s or 70s as shown in your example in Bank of America? The answer is no. I generally would not unless I have a very strong conviction. And that's exactly what I said before in Bank of America. Even if you had a 10% gain in Bank of America, you would barely make any money on that particular trade. And that's why, I was telling you that this call option is too expensive. And that's exactly what the options play score is telling you, is that this call option is too expensive. And even the spread here is too expensive. Is there an ideal options play score? No, there isn't an ideal options play score. An options play score is just your risk to reward ratio. So is there an ideal risk to reward ratio? The answer is no. You just want to know what your risk to reward ratio is. Is there a way to manually adjust delta for comparisons? I don't know what you mean by manually adjusting, because you can't adjust the delta. Delta is just, it is. Each option has a delta. You can't adjust it. You can calculate the delta, but you can't adjust it. On the left side, we get these little circled symbols. What do those mean? on the left side, circled symbols. I'm not sure what you mean by that, Don. If you could clarify, I'm happy to answer that question. By trading spreads, do you get better probability? Yes, you do get better probability. It's not by a whole lot, but it does improve probability. So let's go to GLD, which I think is more of an extreme example just to show you. The probability increases from 32% to 37% probability of profit. So you reduce your risk, you increase your probability of profit, and you potentially increase your rewards if you are correct. And that's why these spreads make a lot of sense for directional views. Would you please talk about Gilead's trends, which operated this morning? So not sure I have a lot to comment on it. You know, basically this is a pharmaceutical stock that's in the running for some of the coronavirus drugs. And it's been trading in this fairly tight range. We expect it to continue to trade in this very tight range, which is why we're selling credit spreads. So that as long as it remains neutral and drifts a little higher, as it has been doing over the last few weeks, will be profitable on this particular trade. So very different strategy than we're going to talk about, what we talked about here today. For those of you that are interested in learning more about credit spreads, I will talk about that in the intermediate course. A little bit more advanced strategy. It's similar to selling a naked call or a put, but doing so without limited risk. But it is a strategy that we are implementing in this current market environment. A debit call spread and its inverse credit put spread both represent a bullish view in the underlying stock. In what scenario would you pick one over the other? Those are two very different scenarios. Just like how buying a call option is very different from selling a put option, that's how you think about a debit versus credit. A debit is a bullish by a certain amount. A credit is a bullish but not too much. So a credit put spread is when I'm bullish but not too much. A call spread is when I'm bullish by a certain amount. That's the best way to think about it. How about giving a little bit more time to June? You absolutely can modify any of these strategies and change the expiration date to June. You can change it. We encourage you to trade these types of strategies and play around with the expiration dates. We really designed this from the ground up to make your trading as simple or as easy as possible. We want you to explore these types of strategies, in my opinion. Are those annual returns? No, these are returns that are just, these are not annualized at all. These are just returns that you would expect on these particular trades. Michael, you're very welcome. Thank you so much. Wow, a lot of questions. I'll try to get to as many as I have time for here. Does the vertical call strategy assume that I own the underlying stock? No, you do not have to own the underlying stock in order to trade a vertical call strategy. Scott Boyd, nice to see you. Thank you so much for stopping by. If it's a Scott Boyd that I think, if Scott, if you are who I think you are, it's been a long time. It's 10 plus years since we've probably seen each other. Is delta also a probability indicator? Yes, delta is also used as a probability indicator. Delta can also be used as a proxy for probability of being in the money. So something with a low delta has a low probability of being in the money. Something with a high delta has a high probability of expiring in the money. One pays for taking the risk while the other requires to invest. I don't think that that's fair to say, and I think you're referring to the difference between a debit versus credit spread. I don't think that that's the best way to look at it, in my opinion. I actually have a webinar on differences between debit versus credit spread. I highly recommend you to take a look at that on our YouTube channel. I think that might give you a better understanding of the difference between it. Michael saying, is gamma constant, does this change as delta as well? Great question. Gamma also changes as well. So this is really where you can get into second, third, fourth order derivatives, but gamma does change. Gamma is most sensitive to time. And it's also most sensitive to whether you're in and out of the money. So gamma is most sensitive when you're at the money and you approach expiration. Gamma actually approaches infinity. So again, this requires a little bit more understanding of kind of slopes and calculus, but if you do want to look at some of those YouTube videos, there are some great channels talking about derivatives and calculus if you want to learn more. But gamma does change with time and with the price stock. Is there any reason you don't cover Vega? It's not that I don't cover Vega. I'm actually going to cover Vega next week on our earnings play, because that's when we're going to talk about how changes in implied volatility affect your options price. What time for Friday's webinar? It's 9 a.m. Eastern. Lucy, you're very welcome. Dean, very welcome. Enrique, could you sell the vertical anytime before expiration? Great question. Yes. Whenever you buy a vertical spread, whenever you buy or sell any option, you can always close it before expiration. Doesn't matter what strategy you're trading, whether you're buying, selling, you can always close an options trade before expiration. Peter, Frederick, thank you so much. Will you teach about credit spreads? Yes, I will. It is coming up. When is the best time to have success on spreads? I'm not sure what you mean by that, James. If you don't mind clarifying, that'd be great. In the options play tool, is there a way to play both bearish or bullish? I don't know what you mean by play both bullish or bearish, because you can select I'm bullish and see bullish strategies, and you can select I'm bearish and see bearish strategies. I'm not exactly sure what you mean by or. Neil, thank you so much. I really, really appreciate Jake, Jan, everyone. Thank you so much. Robert, thank you. Haley is asking, so Tony, I have to ask, how old are you? And if you'd rather not say exactly what movies were hits in the theater you were born. I've already spoken about this on CNBC, so it's not a secret anymore. I'm 33 years old. I've been working in financial services since I was 19. I started at a company called Forex.com. Actually, Scott Boyd, who, if that is Scott Boyd, we used to work together at Forex.com, started on the floor helping retail traders understand how to trade currency options, currency options. You know, got into futures trading options on my own. Had the opportunity to start options play about 7 years ago. Did a lot of work, you know, prior to that with institutional clients. Had a lot of experience in technical analysis from trading currencies and futures, and really got into trading options, you know, about 10 years ago, and started options play because I thought there had to be a better way to build better options trading tools. I was the trader that had 4 monitors on my desktop to trade options. I had Thinkorswim across 4 different monitors, chains, charts, analytics, you know, all the things. And we just thought there had to be a better way. And that's why we started options play. So Haley, thank you so much for asking. I hope that answered your question. Mark is saying, I sold BA 125 puts expiring in April, took in $3 and have been doing this on a lot of stocks. If I get put the stock, I don't mind, as I have set the strike price about 10 to 20% off the lows. What are your thoughts on the strategy? It's a very popular strategy right now, especially if you think the markets have bottomed. I will say that the jury's out on that. But on stocks that you think, you know, for example, a lot of the banking stocks, going into earnings season, once earnings season, you know, if you think that trading below book value is a good time to buy them, selling put options, I think, is a great way to potentially, you know, owning some of those stocks. Will you have your COVID charts? Yes, I will have my COVID charts tomorrow. I will say that they're becoming less and less relevant. What we're looking at more and more are really the economic, you know, impacts of all of this. That's far more important, in my opinion, right now. Earnings coming up is far more important than some of the COVID trends. So, you know, as we get over the hump, COVID becomes less and less of an issue for us to look at. We're more interested in understanding the economic impact of all of this. Canada, yes, the Canadian version of options play is free because the Montreal Exchange pays for it. What is your outlook on banks? So I would say, you know, focus on the banks with the strong balance sheets, Bank of America, Goldman Sachs. Goldman, interesting. The banks that have more trading operations, I think, will fare a little better than the banks that don't have such strong trading operations. Regional banks certainly will likely suffer a little bit more, but JPM, Bank of America, Citigroup, well capitalized, don't have a lot of toxic assets on their balance sheets, has a strong exposure to trading. You know, look at stocks like NASDAQ, Intercontinental Exchange. Those stocks are near their highs because trading volumes are higher, and they benefit from that. So some of the banks that have a large trading exposure also benefit as well. How does next week look in your view on SPX? So that's what I'm going to cover tomorrow morning at 9 a.m. My views are that we kind of overshot a little bit to the upside here. We did break above 273, which certainly puts us in a more of a bullish stance, neutral bullish stance. But, you know, I don't know that we'll stay above 273 for very long. If it breaks back below 73, 273, I think that's where we can kind of resume a bit more of a sideways motion in this particular market. But I will discuss that tomorrow morning. Yes, this video will be in our channel, Enrique. Do you, Kaz is asking, do you remember trading debit spreads for beginner options trader, and will your brokerage firm allow you? So most brokerage, well, I guess it depends on your broker. It's hard for me to comment on that. You should ask your broker whether or not they'll allow you to trade spreads. If they won't allow you to trade spreads, start with calls and puts and then slowly graduate to spreads. I would argue that if you're brand new, you should buy a call or a put first before you buy a spread. It's important that you also learn the basics first. Thank you so much, everyone, to all of you that had expressed your thanks. Is delta also a probability indicator? Yes, I think we've discussed this. Keith, have a nice weekend as well. What's your refresh rate for spreads and volatility and the parameters that are used by options plays? So it's pulled in live every single time you pull in a new symbol. So there isn't a delay there. Hi, if I put a debit spread that's in the money on both legs with the same expiration date and only 1 week left to expiration, how would you close both legs? Would you close both legs? First of all, I wouldn't trade a spread that's only 1 week from expiration, at least not a debit spread. I might trade a credit spread, but certainly not a debit spread. So first of all, I would suggest that you trade longer dated, 4, 5, 6 weeks going out. But I certainly would never trade a debit spread in that last week. So that's why I wouldn't open a debit spread in its last week, Wallace. What information do you use to determine if you see a stock going up or down by a certain amount? What information do you use to determine if you see a stock? Oh, so usually technical analysis, momentum indicators for the most part. Irene, my broker won't let me do spreads. I'm thinking of changing from Schwab to Better Options Broker. So there are plenty of options brokers out there. You know, I can tell you that, you know, Tastyworks, TD Ameritrade, Merrill, these are all great brokerage firms that you're just going to have to apply and see if they give you access to trading spreads. From all the possible combinations for vertical spreads, what drives your recommendations? Is it purely based on score? No, it's based on best practices, which is buying an at-the-money call or put and then selling roughly a 15 delta call or put against that, which is something that only has about a 15% chance of the stock exceeding that level by that expiration date. What kind of winners do you have opposed to losers, and how many years of history? So our win ratio is about 60-40, but you know, win ratios really don't mean a whole lot because there are plenty of people that have 80-90% winners that still lose money in the long run because the 10 to 20% of the trades that they lose on, they blow out their entire accounts. And that's very common for selling credit spreads that are really far out of the money. People who sold those types of credit spreads going into this sell-off that we just had over the last couple of months probably gave up the last year's worth of gains. It's unfortunate. And I really, you know, I feel for those people because, you know, it's a strategy that works 95% of the year. And you're thinking to yourself, I'm collecting a really nice dividend yield until it doesn't. And many of those strategies have 80 to 90% winners. And that's really why I really don't want anyone to focus on winning percentages, because it has nothing to do with winning or losing. I'm sorry, it has nothing to do with being right or wrong. It has to do with how much money do you make at the end of the year. That's the only thing that matters. So especially for those of you that, you know, anyone that's ever learned game theory, if you know the difference between an infinite versus a finite game, like a game like basketball is a finite game where there's a set of rules and there's a clear winner and loser at the end, trading is an infinite game. There's no such thing as winning or losing. It's just who has the will to survive, and the people who can't survive are the ones that drop out. Those are the losers. So if you think of it that way and you approach trading from that perspective, it's really going to change your philosophy as to how you manage your capital, how you manage your money, because that's the important thing. Once you blow up your account, you are no longer in the game. And everything that you do is to stay in the game. How do you do that? You manage risk. for those of you that want to learn a little bit of game theory, I highly recommend you to do a little bit of reading on that. It'll shift your perspective on how you think about trading completely. How to trade a straddle. So straddles are not difficult to trade. You just enter an order to buy or sell a straddle. You know, I don't know what your question means in terms of how do you trade it. You can just enter the order for a straddle. Any reason you don't use credit spreads? We absolutely use credit spreads. That's the trade that we just put out this morning on GILD. Have to wait to near expiration. Generally speaking, you would not trade these near expiration. Difference between debit spread and a straddle. Those are two completely different strategies. Debit spread is a directional strategy. A straddle is not a non-directional strategy. Is there a way to enter your long portfolio into options play in order to look at income strategies? So James, we are currently working on that, and that we expect that to be out next month. Michael, thank you so much. I see you in the morning. Julio, anyone can join the webinar tomorrow morning, but we are going to make the recordings only for members going forward. What does the options play logo next when placed a stock in the trade idea? That simply means that this stock met multiple ideas. It generated multiple scans. So in this particular case, it triggered both the William percent R scan as well as the CCI scan. So many more questions. I really appreciate everyone for taking the time out here this afternoon. Unfortunately, I won't be able to get to all of your questions here today, but I really appreciate everyone staying on, learning from this experience, participating, providing your thoughts, providing your questions, and I hope that I was able to answer, some of your questions. Thank you so much for taking the time out here this afternoon. I will send out the recording to everyone, and I hope to see everyone on the market webinar tomorrow morning. Thank you so much and have a great evening.